This is Rovin Remax. Remax Crossroads First Realty 3. I'm Linda Montgomery, and I'm roving around North Texas, highlighting all the people, places, and things that make this a great place to live and invest in real estate. Our guest today is Scott Drescher with Highlands Residential Mortgage. Hello, Scott. Thanks for being here.
Thank you for having me, Linda.
If you would please give us a little bit about reverse mortgages. I hear so much about them, and I think there are a lot of misconceptions. Just describe them for us, would you?
Okay, sure. So a reverse mortgage today is most often going to be an FHA insured product. It's called a home equity conversion mortgage, or HECM for short, because we pretty much turn all government programs into some kind of an acronym.
Of course, it's a rule.
So it's a HECM. But a reverse mortgage, the way most of them are done today, it's an opportunity for somebody who is buying or already living in a house. People don't realize you can use a reverse mortgage to purchase, to have a mortgage and not make a monthly payment every month. So all of the interest and the mortgage insurance just get tacked on month by month so that they don't have that cash outlay every month. So it's a benefit of being able to own a house and live in a house for as long as you want to and never have to make a monthly house payment.
Well, who is eligible to do this kind of thing?
You have to be minimum 62 years old to be a borrower on a HECM. And so that's really, other than having decent enough income and credit to show that you're going to be able to pay your taxes and insurance over time, on time, because they never want to have to foreclose because somebody didn't pay their property taxes. But otherwise, you just have to have equity.
Well, does everybody benefit from thinking about getting a reverse mortgage?
I would say no. There are many times when I'm counseling a senior and we determine that it really is not much of a benefit to get a reverse mortgage because they have enough cash flow and they have enough liquid assets to not really need it. However, more and more these days, financial planners are saying, you're going to need it in 3 to 5 years. It's better to go ahead and set it up now as a line of credit and then use it when you need it, instead of being forced to rush and get it when you need it and you could have had it in place already. So it's always important to talk to your financial planner and not just your lender. Because remember, all lenders are in the business of doing mortgages. I'm rare in that I tell people often not to get a mortgage, but it is important to know whether it's better to go ahead and set it up now instead of later. Those lines of credit can really come in handy when all you need is enough money to do a quick air conditioning replacement, and then you're not paying interest or FHA mortgage insurance fees for the money you never took. You only pay it on the portion that you've taken.
So this is really a good product for many people as long as they understand when it needs to be used and whether it works for them.
That's right. And you never want to take the money out in order to take risk on a different investment because you're encumbering your house equity. You also don't want to do it, in my opinion, to lend money to adult children or to spend money frivolously, because it really should be there like Social Security money. It's there to help you to survive and to live and not to take chances with. So I see too often seniors who take money out of their home equity to help a 50-year-old adult child that's not a child anymore, that should be able to take care of things on its own.
That would be unwise.
Yeah, but sometimes happens.
What happens if the person dies or they want to sell the house? How does it work then?
Okay, so let's not be macabre.
No.
And let's go ahead and talk about in general what happens when you don't need the mortgage anymore. So you must repay the loan one way or the other when the home is no longer the senior's primary residence. So let's assume, to be nice, that they didn't die. They just are leaving the home, and they're leaving it permanently, moving to South Padre. And so you get 4 options always whenever you have a reverse mortgage. And those are, since you own the house, you never give up ownership to the lender. You own the house just like any other mortgage, so you can sell it and you get your equity, assuming you have equity. If you have no equity because you've drawn everything and you're 110 years old, and so the house didn't go up in value as much as the balance did, if you have no equity, you can just say to the lender, come take the house, you can have it. You would let them have the foreclosure because you don't want to be in the house anymore. You have no equity and it's of no benefit for you to sell it. Third option would be that you would have whoever owns the house, you or your heirs, refinance it into a regular mortgage, because once it's no longer your primary residence, you can't keep the reverse mortgage any longer, so you can just refinance it.
Alright.
Or you can use other assets to just pay it off. So let's just say that the adult children inherit the house and it's on the beach and they love the house and they want to keep it, but they don't want to refinance it because mom left them plenty of money. Then they can just pay it off. So you always have the options. 3 of those 4 options are those that have equity and you want to either sell the house or keep the house. The 4th option is no equity, get rid of the house.
Excellent information on reverse mortgages. We need to think about this a little bit more in depth. Thank you for that information. Of course, we encourage you to talk to your own lender and your own financial planner, but thank you, Scott, for that insight.
You're welcome.